Welcome everybody to the third workshop that we have here at the live Living Arlington Information Fair. We have wonderful workshops, and please make sure mute yourself. All these classes are going to be at the bold video that we have in the web page, and also everything here is recording, so you also can see this later on. Also, please make sure that go to the exhibit hall for this presenter. The next presenter, which is Richard Donahue with Ameris Bank, he's going to talk about first-time home buyers assistance programs and something from lenders and government, but that he knows more of that. So Richard, please take it away.
Welcome. I'm glad you're all here. And by all means, if you have questions, you can speak up. Renee will be controlling that. If you want to wait to the end, we can also talk more. But if it's about a topic I'm talking about, then please feel free to chime in. I'm going to get into the homebuyer assistance programs a little bit later into this. I thought I'd do kind of a quick overview of just the first-time home buyer tips, because one of the things that's good to go over is the process, some do's and don'ts, other things that you might not know that can be a good lead in. And then toward the end, but not that late into it, I'll get into specific programs that I know about and recommend. The first couple things we're going to talk about would be, if you want to switch it, Renee, to the second page. Is the quick steps to home ownership. So the idea here is to kind of give you, like I said, some tips and some words and processes that you need to know in advance. I'll go in a little bit about the lender process overview about what would happen once you start, so you know some of the terms and some of the things to expect. Then, as we were talking about, we'll get into assistance programs in particular. And then lastly, question and answer. If something you didn't understand, we can try and address it. We do have 45 minutes, so we can get into a little detail. We can always go into something more detailed on your own situation, and my email and so forth are going to be there on the various pages of this thing. Renee, can you go to the next page? So this may all sound obvious, but the steps to home ownership, it's pretty good to start here. Education being the first one. And the reason for education is there's a lot of terms and there's a lot of information that you can get out of this by taking the class. There's an online class. One of the best, and it's free, is at the Virginia Housing or VHDA website. So it's virginiahousing.com or vhda.com. I've taught a bunch of them, so I do have experience in it. We won't do that whole thing here, but it is similar to what we're going to do here. This is just a short version. Credit history. One of the things that's the most important is your credit. Knowing about your credit is important. A lot of people, and just I had all week long, I've been dealing with someone that keeps talking about their credit karma. That's important to know about. Trust me, everyone at this point knows their credit score, but there is a difference between the two. Our credit is usually a little bit lower score than what Credit Karma. Ours is a little bit more less time sensitive. So I have people that say, hey, my credit score just jumped up from 680 to 700. Let's recheck my credit. It could take 30 to 60 days for ours to pick up. So it is good to know your credit, but it's also good to have a full credit pull done at the same time. A Credit Karma is not a number we use. You can't make a credit decision based on Credit Karma because that is more of a real-time one. The next one is budget. No, not the next one. Go back. The next item on this list here, I'm going down the list here on this page, is your budget. They don't really like to use budget anymore. They call it a spending plan. The reason I guess they don't like it is people have a negative connotation of budget because they think it's holding them back. But the reality is, if you can look at what your income is, your gross and your net, You can plan for where you have parts that need to be worked on, lower, and that way you can sort of work toward possibly low-end debts, lower spending, or identify areas where you can start saving money, because that may be a problem. If you don't have money, that's why we're going to get into the whole down payment assistance programs that can give you grant money. Well, research is probably just looking at different programs online. Again, vhda.com or virginiahousing.com. That's a good resource because they have a lot of good programs and information there. So loan pre-approval. This is something that, again, a loan officer like myself would do. It is free. So if anyone's charging you for this, I recommend asking a little more about that, because it is typically done free of charge, no obligation. Basically, we're going to take the documentation that you provided. That would be the pay stubs, the bank statements, possibly pull a credit report. And we're going to look at that and then come up with an amount, a loan program, and that you could work with or that we think we could get you approved. The reason they have your priorities here is on that research end. You want to learn about where you're looking. You want to learn, is it going to be a condo? Is it going to be a townhouse, a single family, the commute, the schools? So those are things that the realtor needs to know. But at the same time, when you're talking to me, you can't be telling me it's going to be a single family home when you're probably going to qualify for a condo. So there needs to be a conversation about where you want to buy, the prices, and the fees involved, which again, you don't know in the beginning. That's why you're researching these things, to find out the area, the commute, the schools, and so forth. The search. Once you have a loan approval, pre-approval, excuse me, you're able to start the search with a real estate agent. Again, I'm going to give you a price range. I'm going to give you a loan amount range, a payment amount range. And as you're looking, you're going to feed those back to me and say, hey, what is this sale price on this one? What's the payment turn out to be? How much it's going to cost? And quickly I can turn that around and give you an estimate saying, well, based on what you sent me and your debts and your credit, this is the type payment it's going to be, and this is the type cash it's going to cost. So that can be turned around quickly, and that can determine whether or not you make an offer. So when you do say, okay, let's go ahead, then I'm going to, fine tune the letter I give you, the pre-approval letter, and give it to your agent, and you're going to make an offer. And that's the next step, which means you're going to have a home, because you're going to have a ratified contract, you're going to lock your rate in, and you're going to proceed. So let's go to the next step, please. Next page. The lender will see. So the reason we have this down here, how much you can afford, credit, budgeting, selecting a loan program, down payment, and closing. So those are all the things you're going to work on before you even have an agent, before you even have a house. You're going to start looking at the payment. I'm going to send you an estimate and say, I think you can handle $2,000. And you're going to have to work that into your budget or spending plan so that you can say, wow, that's higher than I have. How am I going to do that? We're going to look at your credit. And I talked about Credit Karma. Again, Credit Karma doesn't have, all the info on the trade lines, the payments. There might be a judgment there. There may be some kind of medical bill. So those are things we check in the beginning just to make sure you don't have any surprises. It's good to get it done in advance. A credit report is good for 90 to 120 days. So if you do pull it with us, and again, we don't charge for a credit report in the beginning. You only really pay it when you do have a house and you start ratified contract settling. We can go through it line by line and just make sure it's what you think it is. Are there student loans on there? Are their payments are correct? Is there something in there from some relative or some parent that you didn't know about? So you want to get that straightened out in advance, because you can't just fix that in 10 days or 2 days. Sometimes it takes 30 or 60 days to get these things that aren't correct updated. So we advise doing that way in advance, at least 90 days, so that no surprises show up. The budgeting aspect, the reason that's important is you may be currently paying $1,400 a month in rent or $1,600, and I qualify for you $1,000. Well, that's kind of a problem. We need to go back and find out why or how we can get you up to an amount of 14, 16, or 2,000. And there may be something we have to do, restructuring a loan or paying something off, or maybe having to prove more income. You know, maybe you have some income that we didn't see that's extra, like overtime or bonus. So again, budgeting is important so that we can figure out, you know, how much you think you're going to qualify and how much we think. Selecting a loan program, one of the things you want to do in the beginning is determine what's the best way for you. Since there's so many different loan programs, it's good to also find out about them. Are you going to go conventional, FHA? Are you a veteran and you're thinking about a VA loan? So we're knowledgeable about all these programs, but some you may not qualify for. Your income may be too low or your income may be too high. So you're going to kind of fine tune that and come up with, hey, I decided this is the best thing I can do and I'm going to proceed with it. And then there's no delay. When you find a house, you really don't want to be trying to figure out what loan program. You want to have that sort of ready and you're in good shape and you know the parameters and you feel comfortable that that's the program for you. And then you have a house. Down payment and closing. One of the things people get a little confused on this, not unusual, is the down payment and closing doesn't come in the beginning. It comes at the end when you buy the house and settle. What does come in the beginning, like when you have a ratified contract, is you put a deposit down. And it can be from 1,000, 5,000 to maybe even 10,000. So you have to have some of the funds ready, liquid, to be able to write an offer and give to the real estate agent or the title company. And it's got to be cash. It's a deposit that potentially if you lose or you don't get it or you don't want it, that you could lose. It doesn't happen often, but it's your good faith money that you're putting down to say, you know, I'm putting my 5,000 here and I'm going to go through this. And this is how much it means to me that I put that money at risk. And it has to be, you know, liquid funds, either wired or a bank check. So you have to prepare that. It can't be, you know, in cash. It can't be with a friend or a family member. It's got to be ready to written the day you have a ratified contract. We already talked a little bit about the pre-approval. So obviously when you're looking for that, we give you one in the beginning that's kind of a generic one, doesn't have a property. You got to understand what it means and that there's no conditions of it. Like, hey, I need to do this, or hey, I need to do that. Got to make sure those are taken care of. Okay, Renee, please flip to the next page. Documentation. The reason we talk about this, and it is a little dated because we did used to have to get tax returns. We don't get tax returns near as much. Part of the reason is if you're a W-2 employee, we only need the last 2 years. There was a time, no matter what, we had to get tax returns. The reason we might look into tax returns, let's say you have a W-2 job, but on the side, you have some other Schedule C, some other part-time gig economy work, like driving for Uber or Uber Eats or Lyft. That's okay. The reason we need tax returns is we want to see what you show on your taxes for it. And we only go back 2 years on that. So let's say you've only been doing it for a year. Well, that's a problem because we won't use it unless we have a 2 years on your tax returns pay. So that's a reason to have that available and ready. And also we don't need state tax returns. It would just be federal tax returns to show that. It's a little more complicated and every person has a different scenario on their income. But if you have that, then you do want to bring that up in the beginning and say, what about this income? So we can see it and make sure it's going to be counted and it's valid. Pay stubs, we actually do look at pay stubs, bank statements, you know, the proof that you have the pay isn't on the bank statement. So I've had recently people say, well, my pay shows up on the bank statement, but remember on the bank statement, it's a net number. And yes, it will show who it is, you know, your employer, but we want to see the gross number and that's on the pay stub. And we want to see a month of it. The reason that's important is, you know, you live by your net income, but we qualify you by your gross on the pay stub. So we want to make sure we got the right calculation. Sometimes it does show up differently. Like I can tell you many times we have teachers' income. They get maybe paid 10 months or 11 months. So they their pay doesn't really calculate well because it's a different amount. We use an annualized amount. So sometimes we have to get a contract and see what they're really making per year because their pay stub doesn't match up with what we think it is. Also on there, which is important, let's say you have overtime or bonus or commissions. So we're going to be alerted to that. And that's a much harder thing to calculate because we need, again, a 2-year average. So we need to dig into that a little bit. So that's important. If you don't have a pay stub right now, because you just get paid, you need to find out how to get it. Go to your employer, get the password. There's probably a website that's password protected. I would work on that so that you can get us up-to-date pay stubs. We need them within 30 days of settlement. So we're going to continue to ask them, even if you've given me one that's 2 months old, we're going to need one more recently than that. It does say the last 3 months bank statements. That's sort of right, but in actuality, it's usually 2 months. But remember that when you're buying a home, let's say it takes 30 days, you may get a new bank statement during that. And we're going to need that copy to prove that your earnest money check, that deposit check we talked about a little bit earlier, we're going to make sure that that has come through and can be counted toward you because it's come out of your bank account. Remember, we don't use cash. So just a word of caution. I know it sounds crazy, but you want to have your money together. You don't want it moving in and out of accounts and from different people. You don't want to all of a sudden throw in there a couple $1,000s of cash because we can't prove it. The reason for that is they're worried about you borrowing money. Your pay is an obvious one where your money comes from, but if you drop money in from another source, we need to know about it and we need to document it. It's okay if you can prove it, but if you can't prove it, then it's not counted. Another thing that people have done, not as much, but they move money around with Venmo and I don't know, Zelle and these other online things. We don't recommend we don't recommend that at all. The reason is that's very hard to track. Think about it. It just comes in and it's a little thing. It might have a person's name. We would have to get into somebody else's Zen and Zelle and Venmo. And we don't want to get into that. We really want it to be documented just like a check or a transfer from bank to bank if you do it. And we have to prove it. So I would discontinue doing that when you're trying to buy, especially if it's a larger amount of money. You know, $10 or $20 for lunch or dinner, not as big a deal. But it isn't something that I would say you want to get into right before you're buying a home. Credit card information. Well, the reason for that is, and it's good that it's mentioned here, is we're going to need some money, like we talked about on the deposit in the beginning, to pay for an appraisal and a credit report. When you buy a home, the time we do ask for money from a credit card is to pay for an appraisal. It's about $475. It's part of the closing costs. So that means when you settle, you won't have to see that on there as a charge again. It'll be paid. But it is paid in the beginning because an appraiser is going to be looking for that money to do an appraisal on a property. We'll talk about appraisals later on. Information on any other loans, that doesn't usually come up that much, but an example would be if, let's say, you're going to get the money for the down payment or the closing cost from a 401k or a TSP loan. That's okay. You can borrow. That's one way you can borrow money, but we need to document it. You can't just have it pop in, which means you just need to keep that paperwork and have it available so that if we see a $5,000 deposit, we know that your 401k was where it came from and it doesn't count against you as a debt, but we have to document it. Very important to keep track of that. There was a time when we were digging into and looking at landlord information. More recently, probably in the last 3 to 5 years, we don't do that. So that is not as important piece of information that we need now. I have seen it asked for, but not in the last year or two. So that is something that you could probably skip. Renee, can you switch to the next page, please? This is good. Now, granted, this is kind of a quick overview. I'm not going to get into details from each of them, but you know, some people get them confused on what the difference is. But I like to use the example for conventional as it's conforming or it's Fannie Mae. So you probably heard about Fannie Mae and Freddie Mac. Pretty much, you know, that's in the news and so forth. That's what a conventional or conforming loan is. So it's used to be that they were profit companies and they're on the stock market and all that. And with all the financial meltdown, they've been government owned now. I guess that's 12 years, 2008, 2009. So they're quasi-government backed, but they're typically, a good example would be for profit, so they're the non-government version. So maybe you would argue they're a better price, but they're also, maybe they're a little stricter. They might want better credit scores and they may have a little tougher rules. Well, tougher than what? Let's look at the next one. See, FHA is the next loan. Now, FHA is a government, and that's a real government-backed loan. It isn't really the government making the loan, but the government guidelines, they're much looser. They're much more able to do someone that maybe doesn't have as good a credit or has a smaller down payment or has some other thing. So if you're trying to get your credit better, the advantage would be, hey, if I can get my credit better, I can do a conventional loan and get a better deal. But if you can't do it in time, or there's no way you're going to get it, to conventional range, then an FHA is not a bad loan. It's actually a better interest rate. It does have something called mortgage insurance, which we'll talk about in a little bit. But that's something that is a necessary evil that you can't get out of based on putting a small down payment and maybe your credit score. Versus on conventional, you have some options depending on your credit and the amount of money you have. So it's good to know the big picture on these. I mentioned earlier about VA. If you're a veteran, that's a great way to go. The VA loan has a no money down option and it doesn't have monthly mortgage insurance. So some pluses right there. The interest rate also is very good compared to other loans. So certainly if you're a veteran, I recommend getting a hold of your certificate of eligibility, which you do need to do in advance. And we can talk about that. The other ones we see less of, so they may get thrown out there, but a USDA loan essentially is a rural development loan. You can't get it inside the Beltway. About the closest you could get one of these is Stafford, Anne Arundel, Spotsylvania, down below Fredericksburg. There is a no money down option, and it is not a bad loan. A little more complicated, but I would say we don't see that many up farther this way in Northern Virginia. Subprime and non-conforming. Now, those are kind of only on here because if you have something that is, your credit isn't good or you can't go with the above ones, then there are some programs out there. We as a bank don't have those. I caution you to say that they probably won't be a near as good an interest rate. You probably would see a rate between 4 and 5%. And you usually have to put between 20 and 25% down to even get one of those. So that would be sort of a resort of last lender. I would try and work on the other ones before you would go that way because you're going to get a better deal and a better payment. Portfolio loans, which we do have because we're a bank, a little more complicated. Typically, that means you're outside the box. Still could have good credit or could have medium credit. Again, typically for that, you have to have 20 to 25% down. But the rate on those typically is not as good, but the last one I talked to somebody about was 3.5% to 4%. So it's not unbelievably bad, but it's something that we do have. And if it makes sense, then we would potentially do it and consider it. The last one is just sort of just the insider term. We call it jumbo loan. It's another name for a non-conforming loan. It typically means it's a loan above $765,000 loan. So for a first-time home buyer, that may not be something that you would get involved in, but it's good to know the term because someone may throw it out there and you were like, oh, I don't know what that is. Ideally, first-time home buyer, you're there 3, 5, 6, 7 years. And then if your income and everything works out enough, you're going to get a jumbo loan, which you could come back to us, but it's going to be typically a higher loan amount, maybe a higher interest rate, certainly a bigger down payment, 20% down at a minimum. Renee, can you switch to the next page? Loan terms. So you can see the obvious one that starts here is fixed rate. And you'll be happy to hear that the fixed rates now are at historic rates. It may not look like it, but I've been doing long time, 34 years to be exact. When I got in the business in 1986, they were at, you're not going to believe this, 11%. My first loan I got, I felt like it was a deal at 10.875 for a 30-year fixed. So they've come down, and I can tell you now, because I deal with them every day, we have rates from 2.5% to 3%. So that's pretty good. So that is why there's a little bit of a flurry right now, or a rush to go out and, if not refinance, to buy a home. So getting ready ahead of time to get these low rates is smart, which is why it's good to get pre-approved, pre-qualified in advance. I don't think they're going to go up anytime soon. I mean, rumor has it that we're going to stay low for the next 2 years. That's what the Fed's saying, regardless of the president, because the economy is in such a state. They don't want to take a chance of taking them up to 4 or 5%, regardless what happens. So, you know, you may not think you want to buy now, that's fine, but getting ready would be smart, because if you have something to do, pay off a car loan, pay off a student loan, something, you know, it'd be good to do it now. So in 6 months to a year, you can take advantage of these. Now, I'll be honest, all the 4 below it, since I've done it a long time, I know all about them, but you really won't see adjustable rates, interest only, or any of the other 15 or 20-year or balloon loans, because the best deal going would be the fixed rate 30-year. It makes no sense to do any of these others. If you have a case-by-case situation, we could talk about it. But even the adjustable rate loans are about the same rate as the fixed rates, because the fixed rates are so low. So they do sound great to have all that talk about those things, but those are kind of old ones that we haven't, we may in the future have them come back, but right now they're not around. Renee, next page. How much cash will you need? It's a good question, because every loan, every person's situation is possibly different. On a lot of the programs we're going to talk about, the least you need is 1%. That sounds a little difficult. The reason I say that is the program may allow for you to put as little as that, but there's the closing cost that has to be dealt with. And we have 3 ways to do it. The seller can pay for some, the buyer can pay for some, or we can pay for some. The way we would pay for some would be to build it into the loan, maybe some of it, or we can do something called a lender credit, where we have a little bit higher interest rate and we pay some of it. So it can happen. The sellers typically are not paying closing costs at all. I mean, occasionally I'm seeing it, but certainly not inside the Beltway or anywhere Fairfax type area. It's just it's such a seller's market. They don't have to, so they don't. So again, on preparation, if you're saying, wow, I have X amount of money, you got to remember that the closing cost is a whole separate number other than the down payment. Even if we have a no down payment loan, which is out there, or even a 1% or 3% down, the down payment is just one part of it. The other part is closing cost. It can be anywhere from, in my experience, $5,000 to $9,000. So it is a number to prepare for. And there's some ways to work with it, which we would talk about, but it's not something that you can get rid of. Private mortgage insurance, this is good because listed here, if you don't have 20% down, you're going to have private mortgage insurance. That's a requirement on all loans. On a conventional loan, if by chance you can get 20%, you avoid that. On an FHA loan, they don't let you take off the mortgage insurance at all, no matter what. It's a government loan, and that's their rule. So the better the credit, the lower we call it PMI, the lower the PMI on it, on a conventional loan. So another reason to get your credit score up is to have the cheapest mortgage insurance. There are different ways to do it. The most popular way is monthly, and it can be low. I've seen $25 to $30 a month, or it can be high, $100 or $200, depending upon the down payment and the credit score in the program. There's also a couple other ways. There's a way to have the seller pay for it. There's a way to build it into the loan. Again, with a lower credit score, it's more expensive. With a higher credit score, it's cheaper. So that's why in the beginning, you're going to go through these examples and options and say, what's best for me and what do you advise, and can you show me other ways? And we can do that. I actually overlapped and talked about closing cost, but closing cost has a bunch of them, and some of the fees that you're going to see on there are listed right below. I mean, appraisal, inspection, homeowners insurance, and taxes are a part of the closing cost. There's about 10 items more. So that's one reason in the beginning you want to go through these and understand what they're for, who's paying them, do you have any chance of negotiating it, and when you pay it. So, you know, again, I mentioned appraisals paid up front. It'll show up at the end, but it'll be bracketed and say, hey, I already paid this. Inspection, that's different than an appraisal. That would be a home inspection. It's paid in the beginning to have someone go out and make sure it's okay. I don't always get into that because it's some people do them and some people don't, but I don't see them under 300. I don't see them over 450. So it depends on the person and the price. Homeowners insurance, currently you may be paying renter's insurance. It's similar to that, except this protects the inside of the house and the outside of the house. And it can be a little bit expensive depending upon, well, your credit, the size of the loan, size of the house, and what you insure. Let's say you have a lot of antiques and gold bullion that you're in the house. Well, if you are, you know, having hundreds and hundreds of thousands of dollars of stuff that you have to cover, your homeowner's insurance is going to be more because they're going to ask you, you know, what do you have? You know, what are you protecting? What are you insuring? So you want to know that in advance. So if you're planning on, you know, doing something like that, you may talk to your insurer and say, hey, you know, give me a quote. What would it cost to insure X? And then that's something you can work on. I can help you look at it. And you can even check with other companies. I would recommend that. Certainly, if you're with a good company like an Allstate or State Farm and they're doing your car, you should get a quote from them and see what their number is. And if it's close to what, you know, you were expecting, we have no problem with you using them. You can use whoever you want. Taxes, those are real estate taxes. They're going to be included in the payment. That's part of the closing costs because we have to collect money to pay the taxes down the road. So we don't have to come back to you or use our own money. It's called escrowing, and it'll be talked about as we get on here. Renee, can you move to the next page? So the reason we have this, we'll start to get into the meat of what I am here for, is don't let the lack of money for down payment or closing costs stop you from buying your first home. The reason for this is it depends on your income. The biggest sort of holdback on these programs is they are income capped. If you make $180,000, well, first off, that's good money. You should have some down payment money, and you're not going to qualify for any programs that I know of that would help you with the down payment. But if you're anywhere from, let's say, 50 to 110,000, just in sort of round numbers on income per year, there are plenty of programs out there. I'll get into a little more detail in a minute about them, but that's the idea. They're income capped. If you make too much money, you can't get it. Still ways to borrow more and have a no money down loan if you make more than that, but then you'll just be borrowing the down payment and paying on it. So that's why the income is important, and programs are different. Renee, can you go to the next? So I've been doing VHDA. Well, VHDA is the initials of it. They do now call themselves Virginia Housing. That has changed in September. So same idea. Virginia Housing Development Authority is based in Richmond. They're a quasi-state program. So they're not really state, but they are backed by the state. And they're a nonprofit. This is the most popular program out there. It's probably in the country one of the more popular programs because VHDA is the second largest housing development authority program in the country. I think the first is California, which makes sense. It's a big state. It's very successful and it's worth looking at. More importantly, if you're going to go this way, you want to go with someone that is qualified to do it. On the VHDA website, there is a list of approved agents and approved lenders that have trained to do these. VHDA highly recommends that you go to someone that's done them before because there are a few little things to them that you need to know. They also do recommend that you take that class. They like to have you take it before you even buy, so you learn all the terms and so forth. And it can be done online and free. We used to teach them before the COVID situation. Because of that, there's less and less of them being taught in person. So online is the best way right now. And it does take a couple hours to do it online, but again, no cost. And it's open book, so it's not that big of a deal. The most you can get on the grant is either 2 to 2.5%. That's of the sale price. So a good example would be, because it's easy to see, if you're buying a $100,000 property, you can get $2,000 as a grant. You don't have to pay the money back. It's free. You do, in the case like that, typically have to put down 3%. So if they're giving you 2, I talked about how typically the minimum you put into it is 1. That would be you put in 1 and 2 goes in there. We still have the closing cost thing to deal with. So that's why I was telling people it's not just $2,000 you need to save up on 100,000. You're going to have to come up with closing costs, or the seller, or we have to figure out some other idea to do it. The minimum credit scores, now these are a little dated. Because of COVID, they've all risen to 640. This does say 620. It was 620 for a while. Fannie Mae is still 640, 660. That's the conventional one we talked about. The reason I should go back on that 2.5% for the grant, on an FHA loan, the minimum you can put down is 3.5%. So if you do an FHA, you can get a 2.5% grant. You still put the 1% down. We do have that 640 minimum credit score on FHA, even though it technically is 620, but COVID has caused a little tighter things. These numbers get a little, next ones on there, the debt ratio. See where it says 45%. The reason that that's important to know about is on our debt to income, which again, in the class, they go into deeper, it's done on your gross monthly income. A lot of people don't know their gross monthly because they live and they get paid on net. So what hits your bank account's net. So that's why we look at the pay stubs. But that takes into account your debts. So that's not just the house payment. The debt to income has the house payment. Let's say it's $1,000. Let's say you have a car loan and a student loan, and that adds up to $600. So we'd have to take $1,600 and divide that into your gross monthly income. It has to stay under that 45% ratio. It's a little more complicated. I mean, certainly if you take the class, there's a worksheet in there that shows you how to do it yourself. It's hard to figure out the payment on your own, but you know, if you figure out your rent and add your, you know, debts monthly, again, minimum monthly, and this is car payment, credit card and or student loan. It's not utilities, it's not cable, it's not cell phone. It's really just the debts that show up on your credit report, and divide that into your gross monthly income, then you can come up with it. Now, I don't expect you to go and do it, but they're bringing it out because we're going to talk about that when you call me. One of the first things we're going to do is say, what do you make? What's your salary? And I'm going to quick do a calculator and say, this is how much you can handle based on what you just told me. And then we work backwards from that. The household income thing, again, I'll go into that a little bit as we get to it, but that's important because depending upon the program you're in, you may qualify for a grant. You may not qualify. Your income may be too high, but you can still get a first-time home buyer program with VHDA because they allow you to make more money and still get that program. And there are some advantages to it. They have some other lower mortgage insurance and a mortgage tax credit certificate, things we can talk about a little bit later on. But there are some pluses to the VHDA, and that's worth, you know, still pursuing. Even if you make too much money for the grant, it's worth at least saying, hey, let's look at what other options they have. A down payment assistance grant can be used with any eligible VHDA loan. You can't use it with like a loan from another company. I have had people call me and say, hey, I want to use a grant and I have another company over here. They got me this deal and I'll apply it. It's tagged to just a VHDA loan. VHDA loans are competitive. Now, I'll be honest, I've been doing it a while. Their rates aren't 2.5%. It's just not what it is. Right now, VHTA, you can get 2.875. That's very good. I have some non-VHTA loans where people have bigger down payments and so forth. And I just quoted someone with 2.75. So they're similar to the lowest you can get on a regular loan, but they're not exactly the same. So they have pluses and minuses. Renee, you can go to the next page, please. So VHDA has one, and it's not, it's been enhanced from what we have on here. The Community Heroes grant is a really good one, mainly because it uses the VHDA loan, but it gives a bigger grant than a normal. So if you did a regular VHDA grant, like on the page before I talked about, it would be 2%. So let's say you do a $300,000 loan. Well, that's only $6,000. 2% of 300 is 6,000. So let's say you did a $300,000 one and you were one of the community heroes, you could get $8,000. So that's a big deal. You don't have to repay it. There are higher income limits, but part of the thing about this is it covers a different group of people. It has first responders, it has teachers, and it has just added nurses and healthcare professionals. So the list it's actually rather long of who can do it. So for example, if you work at a school, high school, grade school, whatever, and you're a janitor, an assistant, a receptionist, you still qualify this. It's not just for teachers. If you're a first responder, like a police or even a EMT or a firefighter, then you would qualify for this. So it's basically sort of the way they're trying to give back on this program. And they were close to running out of money, but they still have money until the end of the year that I know of. And there's probably going to be more money in 2021 because it is the federal government that funds this, and they're trying to help people that are out there on the front lines. So I would not take a closer look at it. It is income capped. You have to make between 68 and 102,000 to fit into that box, but it is varied on family size. So there are a few things there. Renee, can you go to the next page? Now, this is a down payment assistance program that's a little bit different. So I should say that it's not for actual cash for down payment help. It's for a lower interest rate. And it says right there in the middle, it's 1% lower than the current interest rate. So it's funny, but in just the last 4 days, I've locked 2 of these in with people buying. And it's hard to believe this, but they both got below 2% on their rate. I went to the website on VHDA, and it has 2.875 as their standard rate. So you get 1% lower. Now it's restricted. They don't have just tons of money, so it's really first come, first serve. But in Fairfax County, they had $4 million of it. It started out in October. They usually rent out quickly, but someone I was doing a loan for bought in Fairfax, and I sent in the documents, and I should have confirmation on Monday that they're going to get the 1.2875 rate for a 30-year fixed. That's quite a deal. And it goes with any of the VHDA loans mentioned there. So it's hard to believe it's out there. Other people that have it, for example, the other one I mentioned is Loudoun County has it. Now they all have different rules on income. Like for Loudoun County, you have to make over 89,000 and can't make under 110,000. It's kind of a smaller box. You have to live in Loudoun County for the last 6 months or work in Loudoun County. So each locale has different rules. Fairfax has different rules than Loudoun. Arlington County has it, but they have it restricted to certain areas, certain houses, certain incomes. So you can't assume, one, that it's there, and that two, that you're going to qualify for it, because they each have it. A fourth one is City of Alexandria also has it. I know they have it for a fact, but you have to either buy or work in Alexandria, in the city. So you can't use it in Fairfax. You have to buy in the city. You have to live in the city. So again, there's some details about this, and we can go into it further. And if you want to ask questions about it, the second half of this, I'd be glad to go into a little bit further. Renee, can you go to the next one? I mentioned Arlington County. So every county has typically some type of home buyer program. I know Stafford has it, Prince William County has it, Falls Church City even used to have it. I don't think they have it anymore, but Arlington's is a pretty good one because you can see on the last section there, they can go up to 112,000 as a loan, well, as a down payment assistance. It's a little different than a grant. In this particular case, you have a lien against the house. So in other words, when you sell it, you have to also pay that back. Plus, you have to pay a little bit of profit based on the 25% of the sale price in the beginning and the value at the end. It's a complicated one. I wouldn't want to explain all the details here now. Virginia VHDA is the first trust loan we do on it, and they're fine with it. It typically means that you don't have to have mortgage insurance, because if you do a $500,000 loan or sale price, then you could only have to do a $100,000 down payment with this, and you'd be doing a $400,000 loan, which would avoid the mortgage insurance. 20% down of 500,000 is 400. So it's a pretty good deal. There's no payment monthly. There's income caps, and you got to be aware that there are, some restrictions on it. I have the sheet here. For a family of one, it's 68,000. Family of two, it's 77,000. It's on their website. So again, I do a lot of these in Arlington and Loudoun and all, and they do have their particular pluses and minuses, and try to get people too excited on it until we know for sure that they have money. You can find a place, your credit and your income match it. But again, you do need to reach out and say what programs work for me, and then see if this works out. Renee, the last slide I want to say is the question and answer period. So we've talked, actually, I can't believe I talked that long. We've talked past the 45 minutes. So I don't know if there's any questions on here that you would like to talk. They can open it up. Renee can open up any questions you could ask, and I will try and help you, or you could certainly go to the website and I could talk to you in person, one-to-one, even after I do this. Do we see any questions?
Well, hello, everybody. This is Jorge. Essentially, we have to finish the class because we have to go to the next one. But Richard has been wonderful. Please follow up him at the exhibit hall. He has his webpage there, all the information there. So thank you, everybody. Thank you, Richard. And he's live. So if you're gonna call him, this guy is available 24 hours. Well, I'm not gonna say 24 hours, but anytime. So thank you so much, everybody. I wanted to leave you with something before. Let me see if I can do this. And I wanna say, happy Halloween, okay? And go to the next class. It's wonderful. Without a credit, you cannot buy or get a good rate. So thank you, Richard. Bye-bye.
Happy Halloween. Do you got me off or on, or?
All right, thank you.